Stop what you're doing for a second. Close the other tabs. Put the phone down. And look at the price on your screen. What does it say right now? 70-something dollars? Low 70s? Maybe it looks calm. Maybe it looks boring. Maybe it looks like nothing is happening. And that's the problem. Because the number you're looking at is not the market. It's a delayed echo. It's a reflection from a system that is still updating itself after the damage has already been done. This is not a rally story. This is not a chart pattern. This is not speculation. This is a warning phase. And the people who are issuing the warning are not retail traders, not YouTubers, not Twitter accounts. They are the institutions that never warn unless the system itself is at risk. What I'm about to tell you is not based on headlines. It's not based on sentiment. And it's not based on a prediction about where silver should go. This comes from inside the institutional machine, from the desks that see order flow before it hits the screen, from the risk models that don't care about narratives, only survival. This information was not meant for the public. It was not written for education. It was written for protection. And when institutions protect themselves, they move before the market reacts. That's the gap you're living in right now. The gap between what the smart money already knows and what the public hasn't felt yet. Within the last few days, a private internal directive was circulated by Morgan Stanley's commodities division. Not a press release, not a research note, not a media-facing outlook. An internal memo distributed only to select institutional clients, hedge funds, sovereign pools, ultra-high net worth capital. And it contained a phrase that almost never appears in modern finance. 3 words: exit all positions. Not reduce exposure, not rebalance risk, not hedge volatility. Exit. That language is not analytical. It is operational. It is evacuation language. And it came with a deadline, before month end. That alone should stop you cold. You have to understand how carefully banks choose words. Every sentence that goes out to institutional clients is reviewed by legal, by compliance, by risk committees whose entire job is to not create panic. Banks do not tell clients to exit unless the downside of staying is worse than the consequences of being wrong. Because if a bank causes unnecessary losses, they get sued. They lose trust. They lose clients. So when they still choose to use the word exit, it means their internal models are screaming. Exit means the position itself is now dangerous, not just volatile, not just uncomfortable, dangerous. It means the structure supporting the trade is no longer reliable. It means the rules that normally protect participants may not apply when stress hits. This is not about price targets. It's about survivability. And here is the part that removes all doubt. The memo does not only instruct clients to exit, it confirms that Morgan Stanley itself is doing the same. They are reducing proprietary silver exposure to 0. They are stepping away from the market entirely, and they are suspending new silver-related business. Think about what that means. Banks exist to collect fees. They do not walk away from profitable flow unless the risk threatens the institution itself. They are choosing no revenue over unknown exposure. That tells you this is not a trade gone wrong. This is not a bad quarter. This is a recognition that something in the silver market has structurally changed, and staying involved carries risks that cannot be modeled, hedged, or insured. When a bank runs from a market, it's not because they're scared of losing money. It's because they're scared of losing control. The memo uses a phrase that sounds harmless to outsiders: structural changes in the silver derivatives market. That is not Wall Street jargon for volatility. It is not code for uncertainty. It is not a fancy way of saying the price might swing. Structural change means the system itself is no longer behaving as designed. It means the mechanisms that normally keep the market stable, liquidity providers, arbitrage, hedging flows, are failing to function under stress. Think of it like this. Volatility is turbulence. Structural change is the wing coming off. When a derivatives market breaks, it doesn't break loudly at first. It breaks quietly in the plumbing. Orders stop matching normally. Liquidity disappears without warning. Prices gap instead of moving in increments. And when that happens, every model built on historical behavior becomes useless. Morgan Stanley is not exiting because silver is going up or down. They are exiting because they no longer trust the mechanism that sets the price. And when institutions stop trusting the mechanism, the game is already over. Silver is not just a financial instrument. It is a physical commodity with a supply chain. The derivatives market only works as long as most participants never ask for the metal. For decades, that's how this system survived. Hundreds of paper ounces traded for every real ounce in a vault. Everyone assumed settlement would be in cash. Almost nobody stood for delivery. That assumption is now breaking. And when it breaks, the paper price and the physical price stop meaning the same thing. Paper silver is a promise. Physical silver is an object. In a structural event, promises fail first. This is where the split begins. The screen price can fall. The real price, the price required to actually obtain metal, can rise at the same time. That is not a theory. That is how commodity failures always play out. Most people hear inventory numbers and think in totals. How many ounces exist? How many are in vaults? Institutions don't think that way. They think in velocity. How fast is metal leaving? And how fast can it be replaced? Right now, the only silver that matters is registered inventory. That is the metal with a warrant attached. The metal that can actually be delivered against a futures contract. Everything else, the eligible category, is privately owned. It belongs to investors' funds, family offices. The exchange cannot touch it unless the owner sells, and those owners are not selling into a shortage. So when registered inventory falls, it is not a cosmetic number. It is the only buffer the system has. And that buffer is shrinking fast. Not slowly, not linearly. Accelerating. That's what sets off alarms inside risk desks. Because once velocity increases, there is no mechanism to stop it. Now comes the part that no narrative can escape. The math. Silver futures are contracts for 5,000 ounces. There are hundreds of thousands of open contracts. That means there are claims on hundreds of millions of ounces of silver. But the registered vault holds only a fraction of that. Historically, that wasn't a problem. Only a tiny percentage of contracts ever demanded delivery, but that percentage is rising. When even a small increase happens, when 10, 12, 15% of holders say, I want the metal, the numbers no longer work. You cannot deliver metal that does not exist. You cannot fulfill claims with inventory that isn't available. At that point, the exchange has only one option, cash settlement. They don't call it default. They don't use that word. But if you buy silver and are told you will receive cash instead, the promise has failed. And once the market realizes that delivery is optional, paper silver loses credibility instantly. That is the moment Morgan Stanley is positioning to avoid. Because once delivery confidence breaks price, discovery doesn't slow down. It detonates. Beyond the public exchanges, there's a much larger silver market that almost no one talks about. The over-the-counter market, private swaps, forward agreements, uncleared bilateral contracts. This is where trillions in notional exposure quietly live. And this is where counterparty risk becomes lethal. In these markets, silver isn't backed by an exchange. It's backed by trust. Trust that the other side can perform. Trust that collateral will hold. Trust that liquidity will be there when prices move. Right now, that trust is being tested. As physical silver prices detach from paper pricing, short positions begin bleeding in real time. Margin requirements rise. Collateral gets called. And suddenly, firms that looked stable on paper are scrambling for cash. Morgan Stanley can see this because they are inside the interbank network. They see which institutions are drawing emergency liquidity. They see who is rolling collateral at unfavorable terms. They see stress long before it shows up in headlines. Counterparty failure doesn't start with bankruptcy announcements. It starts with silence. Delayed settlements. Rehypothecated collateral being questioned. And once one counterparty fails, the damage spreads instantly. That is why banks fear this stage more than price volatility. Because when counterparties fail, no hedge works. These risks are not isolated. They reinforce each other. Falling inventory makes participants nervous. Nervous participants demand delivery. Delivery drains inventory faster. Drained inventory exposes shorts. Exposed shorts scramble for metal. Scrambling raises prices. Rising prices trigger more delivery demands. This is the loop. And loops don't move in straight lines. They accelerate. At first, the system absorbs the stress, then it stretches, then, without warning, it snaps. That is what Morgan Stanley's models are built to detect. Not the first move, the inflection point. Once the loop reaches critical velocity, no policy tool can slow it. Margin hikes fail. Liquidity injections fail. Verbal reassurance fails. The market stops responding to control and starts responding to fear. That's the phase institutions flee before it becomes obvious. This is not theoretical for them. In 1980, silver broke the system. The exchange changed the rules overnight. Liquidation only. Buyers sacrificed to save the structure. In 2008, mortgage markets failed. The firms that exited early survived. The ones that waited disappeared. In 2022, nickel exploded. Trades were canceled. Winners were erased to protect insiders. The lesson banks learned is simple. When a market breaks, the rules change, and the people who follow the rules are the ones who lose. Morgan Stanley almost died in 2008. They did not forget that. So when their models show structural instability, they don't argue with the data. They exit. Banks do not issue evacuation notices out of generosity. There are two reasons this memo went out. The first is legal protection. If the bank exits while clients remain exposed, lawsuits follow. The memo creates a record. A warning was given. The second reason is control. If everyone tried to exit at once, the market would collapse instantly. Liquidity would vanish, prices would gap violently. By setting a deadline, the bank spreads the exit over time. They manage the retreat. They protect themselves while minimizing chaos. This is not altruism. It is strategic withdrawal. And it tells you something critical. The orderly phase of this market is ending. When institutions shift from participation to evacuation, they are not guessing, they are responding to math. When a major institution exits a market, it doesn't happen cleanly. They don't ring a bell, they don't announce it publicly. They unwind quietly, mechanically, and without concern for optics. And that process distorts price behavior in ways retail traders are not prepared for. When short positions are closed, banks must buy. That creates sudden violent spikes. When long positions are liquidated, banks must sell. That creates sudden, brutal drops. Both can happen in the same session. This is how you get price action that makes no sense. Rallies that feel fake, crashes that feel engineered, because they are. During an institutional exit, price is no longer a signal, it is a side effect. Bid-ask spreads widen, liquidity providers pull back, market makers stop making markets. You'll see gaps where price jumps dollars at a time, not because demand exploded, but because liquidity vanished. That is the signature of a market being abandoned. If this were happening in tech stocks, it would be everywhere. If it were happening in crypto, it would dominate headlines. But silver? Silence. That silence is not accidental. The financial media does not lead, it follows liquidity. They talk about what institutions want you to focus on while they reposition. Silver is inconvenient. It exposes leverage. It exposes shortages. It exposes the limits of paper markets. So instead, you'll hear about earnings, about rate cuts, about anything except the asset quietly destabilizing the system. This phase always looks the same. Everything is normal right until it isn't. The absence of coverage is not reassurance. It's confirmation that positioning is still underway. There is a reason the memo specifies a deadline. Month end is not just a calendar event, it's an accounting event. At month end, banks must mark every position to market. Every exposure must be reflected on official balance sheets. Those balance sheets are reviewed by regulators, rating agencies, and counterparties. If silver positions show extreme volatility or structural risk at that moment, capital ratios are affected, credit lines tighten, ratings come under pressure. By forcing exposure to zero before month end, Morgan Stanley is purging risk from its balance sheet. They want to be able to say one thing clearly: we have no exposure to this. And they are forcing their clients to do the same because client failures become bank liabilities. This is not about profit. It is about survival optics. This is where most people make the wrong decision. They see volatility and think opportunity. They see spikes and try to time them. They see drops and panic. Retail traders confuse movement with information. In a structural event, price action lies. Selling a spike feels smart. Buying a dip feels logical. Using leverage feels efficient. All three are mistakes. During institutional exits, volatility is designed to shake positions loose. Stops are hunted. Leverage is punished. Paper holders are transferred out. This is not a trader's market. It is a risk manager's market. The question is no longer, where is silver going next week? It is, what form of exposure survives a breakdown? That distinction matters now. Strip away the noise, and this is what remains. This is not about silver being bullish. It's not about price targets. It's not about $80, $100, or any number on a chart. This is about confidence leaving the system. When a top-tier institution decides that a market is no longer safe to participate in, the story is already written. Not because the institution controls the future, but because it has visibility into the present that no retail participant has. The silver market is transitioning from a price-managed environment to a risk-managed one. That is the moment where paper dominance ends and physical reality reasserts itself. Once that transition starts, it does not reverse quietly. You are now in the window that exists in every major market event, the space between institutional action and public recognition. The exits are still open. Liquidity still exists. The illusion of normalcy is intact, but the clock is visible now. As more positions are closed, as inventory continues to drain, as counterparties tighten terms, movement accelerates. When the crowd finally notices, the exits don't close politely, they jam. This is not a call to panic, it's a call to awareness, because the worst position in any structural event is the one you didn't realize you were holding. Morgan Stanley has already made its decision. Its clients are being forced to make theirs. The market has entered a phase where participation itself carries risk independent of direction. And that leaves only one real question. Not what silver will do next, not what the price will be tomorrow, but what you're actually holding when the system finishes, repricing trust. The countdown has started. The bridge is still there, but it is no longer guaranteed. Choose accordingly.